Well, good afternoon, everyone, and welcome to today's session, a 2014 accounting update. What's in, what's out, and a look at the accounting marketplace and where we think it's going to go in the future. I'm Bill Carlino. I'm Managing Director of Consulting Services for Transition Advisors, and I'll serve as your host for this afternoon's presentation. I want to take this time to thank everybody for taking time from their busy schedules to attend today's session. Hopefully, we'll have some informative information for you, some good takeaways, and if time permits, I'll be able to answer some questions at the end. With that, let's start. Some housekeeping items first. First of all, the Transition Advisors is a sponsor on the National Registry of CPA Sponsors for NASBA, the National Association of State Boards of Accountancy. In order to receive your 1 CPE credit, you must complete 2 requirements. 1, you must participate in the 3 polling questions I will ask during the hour. You must answer all of them in order to get your CPE credit. Number 2, please complete the evaluation that will appear on your screen immediately after the webinar, and take a minute to complete it before closing down your browser. Once those 2 requirements are met, we will email you with your CPA certificate of completion within 10 working days. So, without further ado, just want to tell you to take a moment. Please familiarize yourself with the GoToWebinar control panel, which is located on the right-hand side of your screen. The orange arrow on the top of the control panel is to minimize the panel, and all participants will be muted during the presentation. But if you have a question, you can communicate with me, or you have a technical problem with us, using the question box toward the bottom of the control panel. Just type your question in the box and click send. And as I mentioned previously, time permitting, I will try and answer all of your questions following the presentation, and we certainly welcome your participation. And for those that I can't get to, I will try to answer them online following the presentation or within a few days. So, just a little bit about us, and I promise you this won't be an infomercial about our company, but a little bit about Transition Advisors. We're a national consulting firm working exclusively with accounting firms on issues related to ownership, succession, and transition. We only work with public accounting firms. We do not do dental offices, medical offices, legal offices, veterinary offices. So we have a lot of experience in that. We do deal facilitation. We help with transaction support, due diligence, succession planning, comp plans, partner agreements, and new partner admissions. So if those are any of the needs of any of our attendees and their firms, just email me and we'll be happy to supply you with more information as needed. Okay, without further ado, again, let's start on today's presentation. First, let's look at today's agenda. We're going to look at some of the numbers crunching of the profession. Then we're going to look at what's in and what's out. Look at some technology advancements, and of course social media, which is becoming a huge presence in the accounting profession. And we'll go a few slides down, we'll go into some of the firms that have successfully used social media. We'll look at what we think the firm of the future will look like. And finally, we'll look at some of the future challenges that we think the owners and partners at firms and staff will be facing in the next 5 years or so. So let's look at the profession at a glance. And total revenue for the accounting profession is about $94 billion. And that includes everything from the sole practitioner who hangs out a shingle to the biggest of the big 4. The number of firms in the U.S., almost 110,000. Now, I know a lot of you have heard different statistics. The AICPA likes to say that there are about anywhere between 45 and 50,000 firms, but you've got to remember also that that includes only firms that are members of the Institute. Many CPA firms in the United States are not members of the AICPA, so they don't really get counted. So we think the figure is about almost 110,000 firms. The annual growth rate from 2009 to 2014, just a little over 2%, and there's a few reasons for that, not the least of which was the ripple effect felt by the recession. Now, accounting firms traditionally are a little slower to feel the impact because first it would hit the accounting firm clients, then it would trickle down to the accounting firm. So that's a good portion of the reason why the growth rate has been at a very low single digit during those years. But as you'll see in the upcoming slides, the future looks a lot brighter for the profession in terms of growth, and we'll look at a few ways how accounting firms grow, whether organically or by mergers and acquisitions. We'll address that just a little bit, a few minutes. And it employs about a little over 500,000 people. As you know, talent, acquiring and retaining talent has always been one of the big challenges for the accounting profession. And we're going to delve in a little deeper on how to find talent, how to keep them, and how to spot if they are partner material. So there's about 500,000 in there. And these statistics were compiled by IBISWorld, which is a global researcher who do a lot of retail statistics, and last couple of years they've branched out to do the professions, and accounting was one of the things that they decided to go on. So according to them, these statistics, these are the 2014, this is what we're looking at. For the top 100 firms, you can see the net revenue is almost $54 billion, and that's, as you can see, the growth rate for that is a lot higher than the overall growth rate for the accounting profession. And we drill down a little deeper, it's the big six. They grew almost 8%. Then you've got firms over 100 million. They grew almost 7%. And then you have the firms under $100 million in annual billings, and they grew almost 9%. And that's certainly a good, healthy sign for the accounting profession. We think that's going to continue, barring any unforeseen circumstances. All right, let's look at some of the very, very popular niche services. And I invariably, at the end of this presentation, I get questions about where do you think the growth lies. And if there's time, I'll address that, as I said, at the end of the presentation. But we'll look at for now, you can see the international tax, with everything going global and with the cloud, and certainly with a lot of controversy now with many American companies going overseas and avoiding U.S. taxes. As you can see, international tax is a huge, huge category. Business valuations, which has always been popular. State and local taxes, or SALT, I'm sure I practice many of you employ at your firms. Attest services. Lit support. Just as a personal aside, our company's been getting a lot of requests for lit support, not only testimony but consulting. So I could attest from our company that lit support is huge. Estate and trust planning, mergers and acquisitions, and we're going to go into that a little deeper about the merger-mania, so to speak, that we've seen in the profession over the past 5 years or so. Forensics fraud ties very, very closely into lit support, nonprofits, and of course the employee benefits field. All right, let's look at some of the client categories that many of you were servicing. Manufacturing and mid-sized businesses. There are probably about 20 million mid-sized businesses in the U.S. And you've got followed by real estate. Many firms we've seen now after it was a little slow when they had the housing, when the housing boom crashed, but now it's starting to pick up. Certainly technology, and we're going to go into sort of the firm of the future and how this is not your father's accounting firm, about what impact technology has had on the profession. Individuals, certainly remaining popular. Construction, again, ties in very closely with the housing boom. Healthcare, and you can imagine how big that's become now with the Affordable Care Act, or Obamacare. For all its pros and cons, it's something that the CPA firms are still going to have to deal with and advise their clients on. Many firms have already been proactive over the past couple of years, actually start distributing newsletters and how to handle the ACA, and even starting new business units, conducting seminars. So you could see that's going to be a huge, huge client service niche in the upcoming years. Nonprofits, followed by wholesale distributors, and of course large businesses. So I'm sure many of you are in these client service niches already, and if not, maybe there is some there that you may want to consider. Let's look at the income per equity partner, kind of the drill down schematics of the down and dirty, so to speak, of the accounting firms. Firms over $20 million in fees, the average partner is making almost $476,000. Firms billing between 10 and 20 million, a little over 420,000. Firms with between 2 million and 10 million in fees, 336,000, as you can see. And firms under 2 million, the average partner income per equity partner now is about a little over 216,000. And the average, if you take that for 2013, which are the most recent statistics that we have, it's a little bit, about 10,000 more per equity partner than it was in 2012. So obviously that's good news as well. And this is according to the Rosenberg map. Now many of you might subscribe to that or read that. That's one of the Bibles as far as the real drill down firm numbers and statistics that we see in the CPA profession. So that's what's going on, income per equity partner, followed by fee growth, and this is excluding mergers and acquisitions. So if you take that part out of the equation, nearly 70% of firms are reporting growth in client fees in 2013. Again, the most recent statistics we have. The next time I do this, we'll have the 2014 numbers for you. More than 40% saw growth of about 1 to 9%, and 30% of firms saw growth between 200,000 and 1 million. Again, now this is according to the AICPA, who conducts a map survey with the Texas Society, which they do every 2 years, I believe. So these are the most recent statistics from them. All right, let's look at what's in. We had mentioned at the outset we're going to look at what's in and what's out. What are we talking about? Mobile technologies, obviously an integral part of today's CPA practice. I'm sure none of you listening, attending today's presentation is without some type of mobile device, whether it be a smartphone or a tablet. Mergers and acquisitions, and we're going to go into the reasons for that and some of the shocking statistics as far as succession, which is sort of an entree to that. The cloud, many accounting firms, probably many of you listening as well, are on the cloud. They have hosted applications. If for those of you who have been in the profession a while, remember when hosted applications first started making inroads back in the late 90s and early 2000s, they were referred to as application service providers, or ASPs. But now it's which was kind of a amorphous, kind of an unclear term. Now it's simply the cloud. Everybody understands that, all hosted. Many of the smaller firms have really benefited from this because they don't have the cost of carrying an IT director or maintaining expensive on-premise servers. So more and more accounting firms are going to the cloud, and certainly all the software vendors have catered to that need. We're going to look at some of the mobile apps and some of the top applications that CPA firms are using. And that's really kind of augured in the emergence of online firms. There are firms that are springing up all across the country. I'll next slide, a couple of slides, you'll see some by name, where they exist solely online. Basically, somebody could start an accounting firm with a computer in a Starbucks as long as you have Wi-Fi. With the advent of hosted applications, that's made that a lot easier. And it eliminates the expense of office leases and bricks and mortar. Many people just work out of their homes. So there's a lot of cost savings in that, and it's just taking advantage of people currently working remotely. So, and then alternative partner tracks. it used to be, many of you who are on the baby boomer generation remember having to work, I don't know, anywhere from 2,600 to 28 hours to make partner. Now the millennials, they're probably not going to do that. There's too many options available to them. Also, maybe some people want a little bit of what we used to call work-life balance. So there are tracks available. So, all right, let's look at. Let's look at some of the top professional issues. Succession. Apologize if you saw that. There was a little bit of a glitch there. Some of the top profession issues. Succession or lack thereof, mergers and acquisitions. Talent wars, how to get them and how to retain them. As we talked about the importance of getting young talent. Pathways to growth. How am I going to grow? Client retention, certainly always an issue. So there's three ways to grow in this profession. One client at a time, or what is commonly known as organic growth. But the economy, or at least the last vestiges of the recession, and competition has made that rather difficult. There are some firms that have grown organically and have done it steadily for consecutive years. Other firms have not been so good at it. So we'll look at that. Or you can develop marketable niches. I had mentioned some of we had looked at some of the client niches and some of the growing ones, and we're going to look at some more that are coming up. Perhaps there's a service line you've been thinking of starting to add to your services. One of the best ways to competitively distinguish your firm is to offer something that's maybe perhaps the firm down the street doesn't offer. The firm down the street offers tax and audit, and you offer tax and audit. Perhaps you'll offer wealth management, and that'll differentiate your firm. All right, so you can develop a marketable niche, or you can merge and acquire another firm. Those are the three pathways to growth. All right, we come to our first polling question of the afternoon, and as I mentioned prior, you have to answer all three in order to get full credit and your CPE certificate. So our first polling question of the afternoon is, what are your plans for growth in 2014? Strictly organic? Planning to develop a marketable niche? Looking to acquire a CPA firm? Or seeking to execute an upstream merger? If our organizer could open the polls and let all our attendees vote. And a couple more seconds to let everybody get a chance to weigh in. Okay, can our organizer close the polls and share the results with our audience? Okay, so everybody can see. And you'll at the end of a couple of days following this webinar, we'll get all our attendees will get an analysis sheet showing the results of the polling and some of the trends of our attendees. Okay, let's go in. Okay, Merger-Mania. We talked about M&A as one of the ways to growth. Look at this, 400 plus deals since the year end 2011. Now we're not quite at the end of 2014, so if my math is correct, that's less than 3 years. In that year, 2011, 55 of the top 100 firms reported at least one merger. Think about that. More than half of the top 100 firms acquired another firm during calendar year 2011. There were 35 of those top 100, 35 of the top 100 firms reported executing a merger in 2012, and 30 of them in 2013. And according to our statistics and what our projections and some of the industry projections, that merger trend is expected to continue throughout 2017. So for at least another 3 years. And one of the big examples of that, which surprised even me, and I've been covering this profession or consulting in this profession for close to 15 years now, was KPMG acquiring the New York, New Jersey firm of Rothstein Cass, which was about a $250 million firm, simply because Rothstein Cass was a big player in the hedge fund market, and KPMG wanted to strengthen that unit. So that's about as big a merger as we've seen in the past couple of years. I'm sure there are some probably on the burner now, but and we'll go into where I think mergers are going to go probably at the end of the session if we have time. I see someone has already asked a question whether we'll see any of the mergers within the Big Four. And I'll sort of answer that now. I don't think so. I think the government would step in. I think they didn't want to winnow down the competition that much. Sort of like the Time Warner Fox News merger. I think somebody's going to step in. There's probably some antitrust issues, but I'm not a lawyer, but that's just my that's my 2 cents worth. Okay, reasons for M&A. Geography, new markets. Obviously, we're seeing our M&A unit is getting a lot of calls for people, say, in New York who want to go in other markets, such as Philadelphia, or maybe they want to go down to Florida, or even across country into California. So if they've already established a footprint in a large city, many of them will want to expand that to see if they have success. Okay, we got new niches such as business valuations and lit support. We talked about new client service lines, starting them. That's another pathway to growth. Maybe perhaps there's a firm offering traditional services, there's a litigation support firm that they're looking at. So this way, the synergies, we're seeing that type of a merger as well. Competition, certainly competition has increased when the economy recesses, as it has in the past 5 years or so. A lot of smaller firms find themselves bidding for clients against firms much larger that normally would not have bid down to that level. But like I said, when there's a recession, they're getting competition from greater firms with larger resources, so they know they really probably can't compete effectively against them at their present size. So maybe they'll merge for a synergy where they could drive new business development a little more effectively. Lack of a formal succession plan. Sadly, you're going to see some statistics about how many firms do not have a formal written succession plan in place. And look at this next statistic. 75% of the AICPA's 340,000 membership will be eligible to retire by 2020. Now they said 340,000 members. Obviously, that's divided between the public accounting members and those in private practice, such as CFOs and controllers. But 75% of those members will be eligible to retire in just 6 years. And here's another shocking statistic. One person turns 65 in the U.S. every 8 seconds. So by the end of this webinar, we're going to be celebrating 450 more 65th birthdays. So now you can see what a critical issue succession is for a lot of CPA firms. All right, let's go. We'll drill down a little bit more because that's certainly part of what's happening today in the accounting market. 80% of multi-owner firms expect succession planning to be one of the most important issues over the next 10 years. And that should really not come as a surprise. But 61% of firm partners currently are over the age of 50. So if firms with that kind of age demographic are not thinking about succession, a couple of years down the road, they're going to find themselves in trouble, and we're going to show you why. Only 46% of firms have a succession plan in place. And firms with less than 15 employees, 70% do not have a succession plan in place, and less than 6% of sole practitioners have a practice continuation agreement. And that's according to the AICPA and their PCPS succession survey, which comes out every 4 years. The next one will be out in 2016. Okay, we're going to come to our second polling question of the day. Does your firm have a formal succession plan in place? Yes. Yes, but it's an informal one. No, but we need one. No, we have no plans to create one. So could the organizer open up the polls, please? Let our attendees vote. And keep it open. A couple more seconds, let everybody weigh in. Again, not to sound like a broken record. And if you know what a broken record is, you just may need a succession plan. Does anybody use records anymore? And we'll close the polls now. And can we share the results with our audience? Okay. Okay, that's our 2 polling questions. We have 1 more before the end of our presentation. All right, one of the most common questions people ask, they ask us, and I'm sure they're asking themselves, is when do you begin the succession process? Well, the first thing when someone comes to us, we ask is how many more tax seasons do you want to work full-time? Not part-time. We never ask if they want to retire. How many more tax seasons do you want to work full-time? And depending on their answer is the strategy that we craft. Then you've got to look, do you have talent on your bench? Like anybody who's a sports fan knows, if you don't have a strong bench, after your regulars are out, where do you go? And if you don't have the talent on your bench, then you're going to probably have to go outside to find a successor, meaning you're going to have to find a successor firm or merge upstream. One of the most common things, I was going to say, the holy grail for many, many CPA firms across the country is a young CPA with a good book of business. People, if I could tell you how many calls we get, I'm looking for a young audit partner. I'm looking for a young tax partner with a good book of business. And unfortunately, those are that's a pipe dream. That's not a real succession, because it's just the law of supply and demand is absurd when it comes to that. A young CPA with a good book of business will be able to land anywhere, and therefore he can go to the, he or she has their choice of firms. But that's basically what we're looking at currently. In 2014, that's the holy grail. But ideally, your formal process for succession should begin anywhere from 5 to 7 years out. Like I said, ideally it should begin that. If you really want to get technical, your succession plan should be mapped out the day you open your firm for business, but rarely do, if any, do firms do that. But it should begin about 5 to 7 years. That'll give you enough time to plan. Once you're down to 2 and 3 more tax seasons, then your options shrink a little. You have less available to you in terms of buyouts and things of that nature. What happens if you wait? Another common question people are probably asking, and the simple answer to that is nothing good. Firms that wait too long to begin planning for succession have 2 options. Basically, a hastily arranged merger with unfavorable terms, or turning out the lights and locking the doors for good. And neither of those are very pleasant. We were a case study. We were working with a firm who waited far, far too long for succession planning. We had advised this owner to start several years prior. He did not. And in the interim, a number of things happened. One, he had a key employee resign. Number 2, he had he needed an expensive upgrade in his IT system. And 3, he lost one of his largest clients. So now he's kind of scrambling, looking for a successor firm that would take him, and he's certainly not going to get the multiple or the terms that he would have gotten had he planned 3 to 4 years ago. And like we like to say, firms that are not proactive in succession planning are surely going to create client and real estate opportunities for those practices that are. So, CPA Mobility. I believe someone had asked about online accounting and accounting firms and how it affects CPA Mobility. Well, here it is. CPA Mobility, which started as a joint effort between the AICPA and NASBA some number of years ago. Basically what it does is allow CPAs to practice across state lines if they have clients without notifying the state boards. So it's the best way I could describe it is if you have wherever you live, I happen to live in New York, if I have a New York driver's license and I want to drive into Pennsylvania, I don't have to notify the Department of Motor Vehicles in Pennsylvania that I'm driving there. My license is transferable in all 50 states. Like I said, this has been endorsed by the AICPA and NASBA. Currently, about 49 states in the District of Columbia have passed mobility laws and are either in the implementation or the navigation phases for CPA mobility. Now there's also a movement towards CPA firm mobility, which basically expands the individual practice to the firm. And in progress, Hawaii is still one of the lone holdouts, and also the U.S. territories, Guam, Puerto Rico, and the Mariana Islands. So that's what's going on with regard to CPA mobility. You would ask what else is going on, some hot niches, some niches that people are going in. Wealth management. Now, for those of you who remember, maybe about 15 years ago, toward the late 90s and 2000 maybe, wealth management made a tremendous inroad into the CPA profession. The prevailing theory was that you're already handling your client's sensitive financial information, such as his tax returns or her tax returns. So if you get licensed, why not make their financial planning decisions for them? You're already handling that. They would be glad to give you that duty as well. But unfortunately, what happened was reality set in, and the CPAs all of a sudden discovered that you can't devote 2 hours to financial planning and 8 hours to tax and make a success out of both. It's got to be an either-or. So as a result, a lot of them just kind of faded out of the wealth management arena. And now, since 2005, we've seen a kind of a big influx toward that. They've decided, and I'm going to show you some firms. Currently, about 100,000 CPAs perform some type of financial planning for their clients. Like I said, it's a natural cross-sell. If you're already handling your financial information for your clients, why not? Why not do their planning as well? And here's some firms that have really mined this space very, very well. Some of them you might recall, know Plant Moran, which is over $8 billion. Look at some of these assets under management that these firms are now managing. Clifton Larson Allen, Gilman Ciocia, which is basically not a traditional CPA firm, but they do tax and financial planning. All right, let's look at Payroll. Now, this used to be the redheaded stepchild for CPAs. Often they'd outsource it. They didn't want to do it. So they usually referred it to a bureau. But technology is changing that. Some firms growing payroll at 20 to 30%. There's been an increase in client demand. People say, why are they going back to payroll? There's been an increase in client demand. One of the reasons, the clients are asking for it. Clients are asking for it, you got to give it to them. A convergence of benefits in payroll now, and you'll see especially with the Affordable Care Act coming in, competition, a lot more firms offering it, so you've got to offer it as well. There's the rising cloud computing apps, which we addressed earlier in the session, and because of that, it's made payroll easier. And a shift in the regulatory arena. Obviously, Obamacare is a big reason. Let's look at some of the employment for accounting. CPA firms, accounting salaries projected to grow a little over 3% throughout 20 to 14. That's according to Robert Half. As many of you know, they're a big financial staffer. Accounting unemployment is at a little over 3% versus a national average, which kind of vacillates between 6 and 7%. And like I said, the hottest commodity is a young CPA with a book of business, and we're going to see that. All right. Okay. Accounting employment. How will firms attract talent and, more important, retain talent? Sustainability. Green accounting. That's going to be another one of those growth fields. Big attraction, especially to the millennial. Paperless office. Now, I know no accounting firm is truly paperless, but millennials are really into the green and the environment. So paperless office big. And things you probably don't think about, like an environment-friendly atmosphere, something like low-flow plumbing, which basically not a lot of people think about. How about not serving bottled water during meetings? Believe it or not, in the surveys I've seen, that's what's important to the millennials. Maybe some bike-to-work incentives to cut down on carbon emissions. These things all figure in prominently to them. And some community projects. Now, I know a lot of you probably are involved with your community doing some events and charitable work, but community projects are very, very big to a millennial. And what's important to retaining talent? Let's look at some of the things. All right, obviously salary. I mean, if anybody says salary's not important, they're just kidding you. But growth opportunities. Is there an opportunity for a young person out of college to grow with your firm? I mean, they might stay for a year, in a cubicle and do, kind of type 1 work, but after that, they want to be challenged. They want to be involved. They want to be mentored. Paid vacation, personal time, obviously. Life-work balance, we talked about it. Open door management. They want to know they can come in and see the managing partner. They don't want the ivory tower type of management that was prevalent in the 60s and the 70s. Like I said, they want challenging projects. Make them part of a team. Then they'll feel involved. Because, like I said, there are just too many options to young people with a financial background than to be stuck in a cubicle. Comfortable office atmosphere, that obviously goes without saying. Firm's reputation and prestige. Believe me, when they come to your office, they're going to know all there is to know about your firm, because with the information available to them on the internet and their knowledge of how to use it, they will know an impressive amount about your firm, whether you've had some bad publicity, whether you have some litigation. Trust me, they will find it. So that's very important to them. And, of course, a flexible work schedule, especially for people maybe the young people wanting to start families. That's very, very important to them. And, of course, not only when they start out, but when they end, their retirement savings, plans, and benefits. They like to see a good benefit package. And, of course, frequent client contact. They just don't want to talk to the clients over the phone. They'd like to see them. They like to go out on client visits. So that's critical to them. So let's look at some of the best accounting schools in the country, where I'm sure some of you do some recruiting. Some of you may have attended some of these schools. All right, Brigham Young, which is the Marriott School of Accounting, Notre Dame, UC Berkeley, Cornell, Illinois, the University of Illinois, Tulsa, University of Richmond, Southern Methodist, Wake Forest, and Tulane. So there are some of the top accounting schools in the country where a lot of talent in the upcoming years is going to be coming from. All right, job satisfaction. Recent survey by CPA, which is the CPA Consultants Alliance. It's a group of leading consultants, which includes our CEO. They polled about 800 people. Most were partners and shareholders in small to mid-sized firms, and the results are surprising. Majority indicated they would continue in public accounting, but a little over 20% were thinking of leaving before the end of the year. And why, you might ask? Okay, too much job pressure, not enough life outside the office. Certainly common refrains you hear. And their salary and benefits not commensurate with their experience. So those are some of the sort of the red flags you may want to watch out for when you're retaining and trying to lure aboard onboarding talent. Let's look at some of the non-accounting skills, some of the skills that are probably important to employers. They recently took a survey where 2,100 CFO and accounting firm partners surveyed on the top non-accounting skills. And general business knowledge ranked as the top one. IT expertise, hugely important. Communication skills. You know, traditionally, years ago, accountants probably weren't the best communicators. Well, and in fairness to them, they weren't trained in it. They didn't have degrees in marketing or or trained in public speaking. They were accountants. But now communication skills is becoming, you know, paramount. Leadership abilities. Sometimes it's pretty easy when you onboard someone. You could see that they have their future equity material, partner material, and you see they have leadership abilities. Sometimes it's not that evident. Sometimes it'll take a few years, but it's critical, obviously, especially when you're looking to build a bench. And customer service. And that's just obviously not applicable just to the accounting profession, but probably every profession and service industry in the world, customer service. And we all have our share of customer service horror stories, I am sure. Let's look at some of the game changers here. There's two. I'm going to auditor rotation. Now, this is something that's been kicked around for probably the better part of a decade. The Public Company Accounting Oversight Board, about 3 years ago, issued a concept release proposing auditor partner rotation after 10 years. Now it's global, not so much in the U.S., but especially in Europe. It's gotten a lot of traction, and I think it's only a matter of time before auditor rotation cascades here. And revenue recognition, again, this has been kicked around probably between the Financial Accounting Standards Board and the International Accounting Standards Board, part of that convergence project. They released a joint standard just recently after 10 years. Basically what the revenue standard does is it enhances disclosures about revenue and provides guidance for transactions, service revenue, and contract modifications. So many of you might be involved in that as well. The current tax code. You think we need tax reform? The current tax code is 7 times longer than the Bible. It's over 5 million words and more than twice the length of War and Peace, just to give you a visual. For many of you who were required to read that in college, that should say it all. It needs about 74,000 8.5 by 11 sheets of paper to explain the code. And we don't expect reform in 20 to 14, but probably what you'll see is a resolution on the tax extenders. Again, the tax code, just briefly, about 74% of small business in the U.S. use outside accountants, meaning the public accounting profession, citing that their in-house financial folks don't understand the complexity of the tax code. And 75% use accountant CPAs for corporate tax services. And then half of these folks who in this survey cited high taxes and complexity among the top 3 issues that are going to hinder their growth in 2014. Those are businesses, not so much accounting firms, obviously. Complexity and taxes. We're certainly hearing a lot about that, as I mentioned at the outset of the presentation, with many global U.S.-based companies going overseas to avoid the tax implications here in the U.S. And it's kind of generated a little bit of a firestorm, saying it's unpatriotic, and I'm not going to weigh in on whether it's patriotic or not, but my suggestion is if it's, you know, if it's that much of a problem, let's change the tax code. Obamacare, like I said at the outset, I could spend an hour on this alone, and you probably have attended some webinars that deal solely in Obamacare. But as I mentioned, vendors, CPA firms offering client seminars, even establishing new business units that offer the expertise on how to handle the intricacies of the Affordable Care Act. When introduced, the ACA was expected to cost $1 trillion. Now it's probably 1.5 times that, according to the Congressional Budget Office, and it's climbing. A good example of a firm that reacted to this very early on was a top 100 firm out in the Great Plains by the name of I.D. Bailey. They established a whole unit on the Affordable Care Act. Dodd-Frank, most of you know about this, created the Consumer Protection Bureau, expanded the authority of the Accounting Oversight Board to oversee the broker-dealer audits, exempts the small filers with a market cap under $75 million from Sarbanes-Oxley 404. And it mandates the SAC to study compliance costs for filers because many of the small companies have complained that 404 was just, an exorbitant cost for them to shoulder. And proportionally compared to a company like GE, it cost them far more. Marketplace Fairness Act, some of you might be familiar with this. It allows the state to collect taxes from online sellers such as Amazon. And this actually breezed through the Senate. We actually had some rare consensus in the Senate, but it's currently stalled in Congress. And it's estimated that in 2012, which is the most recent figures we have, that the states lost more than $23 billion in potential online sales tax in 2012. And that's a lot of money. All right, and we come to our final polling question of the day. And what is the size of your firm? 1 to 2 partners, 3 to 8 partners, 9 to 20 partners, more than 20 partners? And can I ask the organizer to open up the poll and let our folks weigh in? Give them a couple of minutes. And just a few more minutes. And can I ask the organizer to close the polls and share them with share the results with the attendees? And then we'll kind of make our way to the final couple of slides. Let's look at some social media and accounting blogs. There are about 350 accounting blogs currently online. More firms increasing the use of social media. That includes Facebook, Twitter, LinkedIn. Certainly many of you have a LinkedIn profile. Probably a lot of you have a Facebook profile as well. And some of you tweet. Nearly 70% of the top 200 firms have a Facebook and a LinkedIn presence. And last year, Facebook topped the 1 billion user mark. And a good example of a firm that uses all these social media platforms is Withum Smith & Brown, a top 100 firm in New Jersey. Each year they create an annual state of the company and post it up on YouTube, and they get hundreds of thousands of hits. So it's a very effective way of promoting their firm. This is interesting. If Facebook were a country, gave you a visual, it would be the 3rd largest country after China and India and 3 times the size of the United States. LinkedIn user base, about 200 million folks are on LinkedIn. Interesting thing is there's about $90,000 in median income, and another one that's made a lot of inroads the past couple of years is Pinterest. That's kind of more of a marketing blog, but interesting. It's one of the fastest growing social media sites, and 70% of its users are women. And they're women with annual incomes of over $100,000. So that's an importance. Let's look at some of the top technology initiatives. Okay, managing and retaining data, securing the IT environment. I know a lot of states have now passed very strict encryption laws regarding what kind of client information could travel through the internet, i.e. tax returns. Managing the IT risks, ensuring privacy, systems implementation, and obviously fraud prevention is a big one as well. And data analytics. And that's according to the AICPA. They do an annual survey of the top 10 technology initiatives. And these are just some of the things that are hitting firms. And what mobile apps are you folks using? Let's look at some of the big ones. ADP Mobile Payroll, Bill.com, BNA Mobile, CCH Mobile, and Mobile CS, which is a Thomson Reuters product. Some of you probably are, no doubt, are using one or more of these. So these are what are making inroads there. Let's look at some of the mobile devices in the workplace. Typical U.S. teenager sends and receives nearly 4,000 texts a month, and that's not a misprint. They make and receive over 700 calls a month. That's according to AC Nielsen. CPAs, about 90% use a smartphone for business. That's according to Intuit, the makers of QuickBook. 40 to 45% own a tablet, and I think that statistic is rather conservative. And 40% spend about 5 hours a week or more a week out of the office. And in 2014, tablet use among CPAs was may nearly double than it does, as it is. See some more tech trends. Remember BYOB when you were in college? Now it's BYOD, bring your own device. More companies are allowing personal smartphones and tablets to be connected with your company resources. That probably was a no-no 5 or 6 years ago, but more and more people are doing it. We mentioned data analytics, big data, able to analyze and interpret operational financial data for clients. They like to have it drilled down. They like to break it up. So that's what they're asking. And of course, the other one is the last one is probably for firms a bit bigger, cyber risk and storage demands, what they call third-party risk assessments, who will assess your firm for risks. Some of the tech affiliations.
So I'm sorry to interrupt. It looks like the slides are no longer visible on our screen. So I'm going to I'm going to take back the controls and pull your slides up on my screen and just navigate through for you.
Okay.
Okay, give us just a moment. Thanks for being patient with us, everyone.
Where do we have to go back?
No, I think you're fine. We can hear you on the audio. I'm just going to pull up the slides to right where we left off. Okay, so we're on the tech affiliation slide, Bill, and you can just click it from there.
Okay, as I mentioned, there's some more tech affiliations. Avalara, which many of you may use, a very noted sales and use tax application. They've partnered with both the Kansas Society of CPAs and the Maryland Society of CPAs, which allows the members of both societies to access their sales and use tax portal for educational resources. CCH Small Firm Services and eFile Cabinet teamed to offer Portal Safe, which is an online application allowing for document storage and transmission. And Microsoft entering the ERP fray to establish a business process outsourcing program, BPO, which is another huge client niche. Some of you may already be doing it, outsource CFO services. And that's to promote their Microsoft Dynamics and the Navision offerings. They're challenging companies that are already in that suite, which is Intact and NetSuite. Okay. Next slide, please. Let's look at some of the top CPA VARs. Yeah, keep going. You can slide all the way down, Nick. That's great. You can see some of these. You may recognize some of them: Armanino and Crow. And also McGladrey. These are CPAs that have established, CPA firms that have established separate IT units, and they actually resell applications from the various vendors, such as Microsoft, NetSuite, Intact, things of that nature. And you can see the revenue that these are bringing. So this is a trend that will obviously continue for a lot of firms. Okay, let's zip through it here. Firm of the future. Okay. We're going to see more firms doing value pricing instead of they're tearing up the timesheets. Kennedy & Co. out in Kansas, they're a top 100 firm, is a good example of that. Corbett Duncan is another example. You're going to see more specialization, new niches, boutique firms. There's going to be a lot more emphasis on marketing and business development. A lot of firms are hiring non-CPAs, mostly marketing and salespeople, to actually go out and get new business. It used to be the managing partner was responsible for that, but then they weren't really trained in sales and marketing, and in addition, they had their own book of business. So, and you're also going to see more IT spending per full-time equivalent. One of the most overlooked aspects of merging is the IT investment, and according to the industry estimates, it's about $10,000 per full-time equivalent to integrate different systems post-merger. So, next slide. I had mentioned about the virtual firms. Here's a few examples. Deep Sky, it's a firm in California. The CFO is in California. The CFO is in Michigan, and the marketing director is in Atlanta. This firm exists solely online. There's a couple more, BMRG, a Biz in a Box. You're going to see some more real-time accounting dashboards. And obviously, the big one here is more remote workers. You could see the jump from 95 to 2013-14. Now 35 to 40 million people work remotely at least once a week. And I think more firms are being much more flexible about that, allowing workers to work out of their homes or whatever. And then, of course, alternate partner tracks. We've seen examples. There are part-time partners, income partners, profit partners, not necessarily full equity partners. And then more firms are moving to the one firm, one client philosophy, rather than the book of business, rather than the individual books of business, eat what you kill. And there's going to be more niche specialists, again, to forge a competitive point of differentiation. All right, firm of the future, I mentioned outsourced CFO. That's huge. Our company is dealing with a number of clients who provide that service, and that's supposed to hit like $25 billion in fees this year. Greater use of continuous auditing, virtualization of servers that goes into the cloud, and the greater systems integration. A lot more open architecture you're seeing in technology applications, and enabling information, obviously, to mobile devices. Many of you in the baby boomer generation remember those big, bulky cases of audit work papers. Now everything, you can take your iPad to your client. Next slide, please. Okay, this is more pressure on growth and client retention. Obviously, firms facing fee pressure. As I mentioned before, you need to expand beyond the traditional services. Clients demanding more interaction and personal service from their CPA, especially partner loyal clients as opposed to brand loyal. Most of the smaller firms, and I'm sure that includes many people listening now, have partner loyal clients. You have your clients because of you. Firms like KPMG or Ernst & Young, they're brand loyal. People go to them for the brand. They rarely interact with the partners. And a recent survey, kind of a disturbing one, 1/3 of business clients state they're considering switching firms, and the reason is they feel their CPA does not provide enough personal attention. And unfortunately, that's one of the byproducts of technology. It's an unintended consequence. Technology has made it so much easier to communicate via email that the personal touch has been lost in a lot of cases. Next slide. Let's see some trends of the future. Just go down there. We've kind of talked about that. More complex rules, continuing economic uncertainty, new technologies certainly increase competition global. I'll make a prediction now that in 2020 or 2025, 5 of the top 100 firms are going to be from China. I can almost guarantee you that. And specialization, sustainability. That's one of the green accounting, as I mentioned earlier, and international tax for the big mid-market. Next slide. Okay, more firms developing, a bench, talent war for talent. Again, one client, one firm, moving to a flatter organization, not so much the Ivy Tower structure. And then the compensation systems tailored toward reward and entrepreneurship, which is fine, but many firms saying, okay, fine, if I got a rainmaker, I know how to compensate him or her, but how do I compensate the quality control partner? These are things that obviously that have to be worked on. You can't use the same criteria to compensate the quality control partner as you do the rainmaker, because the quality control partner is not going to bring in all that much new business. And a lot of the tax and audit, or what I mentioned at the outset, type 1 work, is going to be handled by paraprofessionals. Next slide. Okay, and we've talked about the one partner, one firm. And what that does is that eliminates basically what we call the Lone Ranger mentality. Frees the partners, to pursue higher level duties such as management and leadership, rather than this is mine, this is yours. Okay, let's look at some of the current profession demographics, and we'll wrap it up. Over the past couple of years, over half of all CPA graduates or accounting graduates are women. 25% are white. Okay, let me just get this out of the way here. 25% of all CPA graduates are non-white, 13% of what we call high potentials are non-white, and 5% of equity partners are non-white. These are the current demographics. Next slide. Well, we think what's going to happen in 2030, projections out, over 1/3 of the partners will be women, 50% of CPA staffs will be non-white, 45% of what we call high potentials will be non-white, and 35% of partners will be non-white. All right. And look at the, certainly look at some of the challenges. Succession planning, I mentioned the dearth of succession planning at the outset. Career development, how to develop the millennials. Alternate partner tracks, you're going to see more of that. Is there another one on this page? And then client communication, which is obviously paramount. Next slide. And that'll do it. I think we ran just a little bit over. If anybody, I might have time for one or two questions if anybody has a question there.
I think we'll actually leave. We just have a couple questions, but Bill will respond to those directly to those who asked, and we can include the responses to everyone if they're of interest in the follow-up email.
Right. If anybody there's my contact information. You're free to email me. I'll be happy to. I apologize for the technical glitch earlier, but once again, I want to thank you folks for taking the time out of your busy schedules to spend an hour with us, and hope you will join us for one of our upcoming sessions put on by Transition Advisors. Thank you, and have a great afternoon.